Welcome to my channel. I'm going to show you step by step how to value a stock so we can determine if it's a buy or a sell. At the end of the video, we're going to look at the financial ratios. Leave a comment and I'll be sure to answer. In this video, we're going to look at Altria Group. This is the parent company of Philip Morris, the producer of Marlboro cigarettes. Altria also maintains large minority stakes in the Canadian cannabis company Cronos Group and the e-cigarette Juul. It is also part of the S&P 500. Let's get started with the model. This company is a big market cap, $81.8 billion. That's the value of the company according to the stock market. Let's get the stock price. They're trading at $44.04, so that's one share of stock. And the way you value a company is you estimate the future free cash flows, then discount that number back to today's value. That's what we're doing in this video. Now I'm pulling their actual free cash flow. Free cash flow is cash flow from operations minus capital expenditures. And then I'm going to pull the net income, which is the profit and loss on the income statement. And we'll put that into the model. Let's also pull their sales. That's also on the income statement. Let's look at the numbers. The sales are really consistent at $19 billion a year. They have free cash flow of $3 billion, then $4 billion, then $8 billion, and $7 billion. So that's lots of cash to do things with. And the net income looks pretty good, although one year they did have negative net income. Let's look at the capital structure of the company. The interest they pay in their debt is $1.3 billion. Let's go to the balance sheet to see how much debt they have. We'll go to the liability section. And then current debt of $1 billion, that's debt due within 12 months. Long-term debt of $27 billion, that's debt due after 12 months. 4.7% interest on their debt. Since interest payments are tax deductible, let's get their effective tax rate. Income before tax of $9.3 billion, income tax of $2.4 billion. So they pay 25% in taxes. Cost of debt is 3.5%. Now let's get the cost of equity. We need the beta. The beta is how volatile a stock is relative to the market. And they have a low beta, 0.46. It's a good stock to buy as a hedge against a volatile market. Let's go back to the balance sheet to get their current assets. We need this to calculate the current ratio later. That's $4.8 billion. And that's $2 billion of cash, $152 million of net receivables. That's how much money other companies owe this company. $2.3 billion of inventory, $146 million of other. Let's get the current liabilities. That's part of the current ratio calculation. That's $8.2 billion. And that's $1 billion of current debt, $325 million of accounts payable. This is how much money Altria owes other companies. And $5.3 billion of accrued liabilities. These are expenses the company has incurred, but has not yet paid. Equity is the value of the company according to the balance sheet. That's $6.2 billion. Common stock of $935 million. Retained earnings of $36 billion. Retained earnings is your prior net income that you haven't paid out as dividends. And accumulated other comprehensive income of negative $2.9 billion. Let's go back to the income statement and get their EBIT. That's $10.5 billion. Let's look at the capital structure. They're 82% debt. Cost of debt is 3.5%. 18% equity. Cost of equity is 5.9%. And the WACC is 3.9%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. That's here in green. We get a value of the company of $157 billion. We divide that by 1.9 billion shares. We get a calculated stock price of $85. They're trading at $44. So they're trading at a 48% discount. So it's a buy according to the model. Let's see what Simply Wall Street says. They're even higher. They're saying it's 101. So the stock is really undervalued according to their model. Let's see where the stock has been trading. So it looks like it was trading much higher a few years back, but it's been dropping little by little every year, and it's at a pretty low point. So this stock should do really well during coronavirus because people need their cigarettes. Let's look at the ratios. Negative PE, not such a great price of sales, and a bad price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, there are 4.1, so investors are paying $4 for $1 of revenue. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, there are 13.1, so investors are paying $13 for $1 book value. A bad current ratio, a good interest coverage ratio, and a bad ROE. Current ratio is current assets over current liabilities, so they cannot cover their current liabilities. That's a little concerning because they have a lot of debt. ROE is net income over equity. They have negative net income, so they have negative ROE. Interest coverage ratio is EBIT over interest expense, so they can easily cover their interest payments. The ratios don't look so great because we're using the 2019 number and they had negative net income, but if we used prior years, they would have great ratios. I haven't done a video of another company in the tobacco industry, so I can't compare them to anyone. But let me know what you think of the video. Leave a comment. I'll be sure to answer. Thanks for watching.